Tesla's stock price is hitting 52-week lows, folks. Today on the video, we are going to investigate this company and whether it's a great opportunity to buy this company based off its current financial statements and the metrics. And finally, we will do a price analysis to find out the intrinsic value of Tesla. But if you are looking to purchase this company, or if you are currently holding this company, you should be excited about this price drop, and I'll explain why. Because when the stock price drops, and if you watch any of my other previous videos, I get excited. And the reason why I get excited about this information is because the stock price becomes less risky. Hitting a 402 on the high side for the 52-week range and 150 now currently where we are currently sitting at on the low end. That is an extremely large gap. But here's the thing with Tesla. Tesla hasn't been a profitable company until 2019. So you circle back to 2019 and you're really just trying to justify the price before that. But now, if you go to their cash flow statement and take a look at what this company's actually been doing, you see that their free cash flow has been in the negatives from 2018 and below. But now currently 2019, it's been positive. They have 3 consecutive years of positive free cash flow, as well as their free cash flow has been growing. You're telling me that this company that was once a $1 trillion company is now worth half of that. Now, granted, the software is not ranking this company very kindly. It's ranking this company a 5 out of 10. What this software looks at is the company's financial statements and basically dissects everything that's going on with the company and things that they are doing right and things that they are doing wrong. For example, their 5-year PE ratio is currently 627.62, astronomically high for a company like this, but currently it's at 42.33. Still, that is trading at a premium. However, as the stock price becomes lower and lower, it will be justifiable by their PE ratio. Take a look at this. Their 5-year average EPS is 0.07, but currently it's at 3.20. So you have a company that has a lower PE ratio and now has a higher EPS. That is just improvement on the business side. The debt to equity is low. Their EPS growth, as we explained, is up. The net income growth is up, so the net income is going up. As we explained, their free cash flow is also going up, and the revenue growth is going up as well over the last 5 years. So Tesla is actually doing a fairly decent job of improving itself as a business. They are getting points docked on the current ratio because it's currently at 1.46, which honestly, it's not that bad. We want to find companies that have a current ratio of 1.5 and higher. 1.5 just indicates to us that they have that little buffer zone. So a 1-to-1 ratio would just mean that their assets equal their liabilities. That 0.5 is a buffer zone for the business. The return on equity average is negative 11.55%. So that's why it's getting no points there. But you look at the company metrics and the cross comparison of what they're currently doing this year, it's at 31.86. This is the turning point for Tesla. This is where I think going forward, Tesla's going to be a very interesting company to take a look at. The last few years, I did not even touch this company until it hit a certain price point. But now I feel like we're slowly getting into that range of where the value of the company will eventually correlate to what the stock price is. What does that mean? I think that this stock price has to fall a little bit more, but we'll find that out in the price analysis section once we dive deep into what we should be paying for this company today. The main point I'm trying to make here, folks, is this company has been improving itself year over year, and the software is showing that. Look at the profit margin for the trailing 12 months, 14.95%, and on average, it's been negative 2.46%. Clearly, you're seeing this company's making improvements. The Piotrowski score is 7, which is great. We want to find companies that have a Piotrowski score of a 7 or higher. 9 is the highest score you could possibly get, and that is phenomenal. The Altman Z score is 11.47. Phenomenal score. We want to find companies that have an Altman Z score 3 or higher. So you see where the discrepancy, you see where this doesn't make sense? So if you are, just to circle back to my initial point, you should be happy that the stock price is dropping, because now it's more justifiable to buy this company at a lower price than what you were previously purchasing it at the higher price that it currently was. Yes, it's heartbreaking to potentially see your investment go down, but if you're looking to get into this company like I am potentially, this is a great opportunity. What I'm going to do, folks, is we're going to bring this into the price analysis section here, and what I'm going to do is 3 different assumptions to try to price out what we should be paying for Tesla today. I'm going to do a 10-year analysis, so basically I'm going to forecast what I think the company's going to do for the next 10 years and then discount it all back to today's numbers, and we'll figure out if this price point is justified or not. Folks, if you're enjoying the video so far, hit that like button and subscribe button. This software that I'm using, you can follow the link in the description box below. Get 7-day free trial. It's a phenomenal tool to actually figure out what companies are worth. It's a phenomenal research tool that I use on the daily. It's called StockSpec. I use it all the time, and we'll see that the company's stock price on average calculation comes out to be 109. So just to briefly explain what I've done, if you're new to the channel, I like to try to stay as conservative as possible and utilize numbers that the companies currently have done in the past to try to predict and guesstimate what they can possibly do in the future with a little bit of a discount. I put in numbers that I believe the company can hit and potentially excel. 20% revenue growth, 22% revenue growth, 24%. Given its current market cap, I think it's possible, and it's currently in that trajectory course. The average calculation comes out to be 109.59. And the one interesting thing here, folks, on the aggressive average, the discounted cash flow formula has come out to an average of 108.99, but from the earnings multiple calculation, assuming a PE ratio of 18, that is pretty lenient, but it's hitting 156.16. But if you agree with these numbers, that means that this company could potentially be a buy. I think this company's stock price has still a little bit more room to fall. I would love it to fall roughly around this $109 realm, and 105 would be great if it can hit my moderate average. Ideally, if it can hit between my conservative and moderate average, that's a Christmas miracle, I think. Tesla is down 60% for this year alone. So is it possible that this company's stock price can fall even further? I think so. If it does, that would indicate to me that this is potentially a company to start going in on. Final thoughts on Tesla. Everything has been improving within this business. As the stock price falls, it seems a lot more attractive to buy it at this price than it does in the last few years. Everything that this company has been doing prior to 2019 just doesn't make sense if you purchase it at that point. You were overpaying for this business tenfold. It has positive free cash flow. It has a higher increase in revenue, has a higher increase in net income. It just needs to fall a little bit more in price because the fundamentals are starting to line up nicely with this business. Anyways, folks, that's the video. And if you want to find more stock analysis videos, follow this playlist right here. It'll take you to a link to all the other companies I've analyzed. And if you want to see a company analyzed, write it down in the comment section below. But better yet, get your hands on the software. 7-day free trial. I love it. It's a phenomenal tool to understand any business, and it goes across all markets. So if you're a Canadian, there is the Toronto Stock Exchange that's available and Euronext markets, but it covers all the companies on the NASDAQ as well. So that's the video, folks. I will see you in the next one. Thank you so much for watching.